Some lessons don't come from books. They come from bruises. They come from life.
There is no substitute for experience, period.
Some of the biggest successes were a byproduct of failure.
If you want to learn, build, and grow,
Why not learn from somebody who's already paid the price for success?
the wisdom is in the gray.
This is the Greybeard Show.
Greybeard Show. Learn,
Build.
grow.
And welcome to the show. This is the Greybeard Show. This is the Insured Money edition. I'm in basically a 7-8 part series on finances. I'm a mentor. I'm a coach. I'm a 3-time 7-figure entrepreneur. I've had 3 completely different businesses, financial services for 22 years. I then transitioned into flipping real estate for 3.5 years, high-end homes in California, and then I've owned an energy company for the last 6 years. And I am also a licensed Texas insurance agent, specifically representing fixed indexed annuities, which are one of the safest, most guaranteed products available. And today I'm going to be talking about Roth IRAs as part of my Greybeard Show Insured Money Edition. This is what we're going to talk about. And so what I want to start with is just a question. I want you to actually answer it in your head, though, right now. What do you think is the single biggest threat to your retirement? The market? Inflation? Outliving your money? Well, here's my answer. After 30 years in this business, it's none of those. It's a chain reaction of taxes sitting quietly inside your qualified money. Your IRA, your 401k. These are like ticking time bombs. Tick tock, that most people never see coming until it's already too late to do anything about it. And that's what tonight's entire hour is about. Educating you on what the problem is, but more importantly, what the solution is to that problem. So we're going to jump right into the thick of it. I'm going to get into point 1, the silent partner. This is going to be a discussion on why I think you got a mob boss partner inside your 401k and IRA. So let's outline that. Before I tell you about anybody else's situation, though, I want to do something with you right now, wherever you're at, in the car, on the couch, doesn't matter. Think of one number. How much money have you got sitting in your IRAs and 401ks combined? Okay, so how much money do you have in retirement accounts? Whatever that number is, okay? Think in your head. How much? Round it up. Whatever the number is. Big number. Okay, got it in your head? Good. Now, here's the question I always ask next. How much of that money is yours? How much of the money that you have in IRA accounts, 401ks, IRAs, those types of things, how much of that money is yours? Most people I talk to immediately think that whatever the account balance says, that's their money. That's not true because you've got a silent partner. He's a mob boss. It's the IRS, right? They own a percentage of your IRA because that IRA has never been taxed. They own a percentage of your 401k because the 401k has never been taxed. So if you're honest with yourself, that number you just thought of is the statement balance. It's not what you can personally walk away with. So let me ask the real question. The one that actually matters. How much of that money is yours? Right now, it's about, depending on where you live, in the great state of Texas that we're in, you don't have any state income tax. So worst case scenario, maybe 60+% of it is yours. Maybe 70% or 75% is yours in the best case scenario, but not the whole thing, right? So I'm going to talk about a couple. Their name are Hank or Donna. They're a theoretical couple, but they represent a lot of people I've talked to over the last 30 years. And I'm going to outline their situation because it's going to be relatable to many people that hear my voice right now out in Radio Land. And I'm going to, through their situation, illustrate the point of what I'm trying to convey here is that 401ks and IRAs relative to retirement income, relative to facilitating retirement, they're ticking time bombs. There's a lot of expense and tax that you do not realize that creates a chain reaction. So let's talk about Hank and Donna. Okay, they're not real names, but a situation I sit across the table from constantly. So Hank spent 32 years driving a route for a regional distribution company, and he rolled his 401k into his own IRA along the way. IRAs are individual accounts, so Donna's retirement savings stayed separate in her own name the whole time. But By the time Hank turned 62, his IRA alone had grown to about $500,000. And when he looked at the statement, he felt like he'd finally made it. Proof the system worked. Proof that discipline had paid off. Here's what nobody ever told Hank, though. That $500,000 was never entirely his. The federal government quietly attached itself to a portion of every dollar in that account decades ago. The moment he deferred the tax on it, when he first put the money in, and left the amount completely undefined. It's a little like walking up to a bank, asking for cash, except every dollar they hand you, they decide on the spot how big a cut they're going to take first. Sometimes it's 20%. Sometimes it's more. You don't find out the rate until you actually ask for the money. I call this the silent partner, but honestly, that's too polite, right? So the more accurate name is a mob boss partner. Think about how it actually works. You borrow $50,000 from a mob boss, let's say somebody who doesn't operate like a bank. That person doesn't quote you a fixed rate up front. It just tells you, pay me back when I say so, however much I say so. Today, maybe that's 10 points. You owe them $55,000 on a $50,000 investment. You're a little slow paying them back. Now it's $65,000 on a $50,000 investment. Take too long. Now it's $75,000 on a $50,000 investment. He's not negotiating. He's not asking permission. He has all the control. And you agreed to those terms the day you opened that account, whether you read the fine print or not. Now, here's the only reason any of this ever made sense in the first place. The entire premise behind a traditional IRA or 401k is that you're 100% convinced your tax rate later in retirement will be lower than where it is right now. That's the whole bet, folks. It's 100% premised on the assumption that the tax you pay in the future is lower than some of the lowest rates we've ever seen in this country. For context, by the way, when the 401k was created back in 1981, that was when it was created. The 401k was created back in 1981. First year it was offered. The highest marginal tax bracket we had in 1981. Guess how much it was. Guess how much Uncle Sam could take of your money if you earned enough in your working life back in 1981. Guess what the highest tax bracket was? 70%. So it would be really a great assumption. It would be a valid assumption at higher rates like that. And by the way, there was like 15 different brackets. We only have 6 now. There are 15 different brackets. So it was easier if you drop down in income because most people don't retire making as much money as they did while they were working. So most people would drop down in income. Well, dropping down just a little bit might have moved you down a bracket or two. That was the premise of why these were set up at that time. That's the whole bet, right? The bet is the tax later is lower. And if you're not actually that confident, if there's a real chance tax rates go up over the next 10, 15 years, deferring isn't a strategy. It's a gamble you didn't realize you were making. Because if you could have paid the tax lower today, knowing what the tax is today, you don't know what the tax is going to be 5 years from now. And you have no idea what's going to happen in this country in 5 years, 10 years, 15 years. But you do know what the tax is today. And here's why that bet looks worse every year. As of right now, the national debt in this country sits at roughly $39,271 million. $39,271. That works out to about $114,000 for every single citizen in this country, newborns included. And it works out roughly, if you're a taxpayer out in Radioland, do you pay taxes out in Radioland? If you pay taxes, guess what? Represents $355,964 for every actual taxpayer in this country. Can you imagine almost $250,000 of our national debt in this country is hanging around your neck? Literally. That's the risk. That's what I'm talking about. So when you think about the future, Trump isn't going to stay in office forever. When you think about the future, I think tax rates are likely going to trend higher given where we are with our national debt. So every one of you driving right now, listening to me, or everyone sitting in an office working for a living is personally on the hook for over $250,000 of that number. Every dollar gets paid back somehow, or maybe it never does. I don't know. Through spending cuts, through growth, or through taxes. Nobody in Washington has to tell you which one they reach for first, which is taxes. It's always taxes. That's not a hypothetical risk sitting out on the horizon. That's the account sitting in your portfolio right now. If you got an IRA or 401k, that is the jeopardy. Okay, so go back to the question. I asked you at the very start of this segment, how much of that number, when you look at your account values, how much of it is actually yours? Not one person out there can tell you what it is. I can't tell you. You can't tell me, because until you go to take it out and whatever taxes we're facing when the year you take it out, that's when you'll know. But see, most people can't answer it. And until you can, you don't actually know what you have saved. You know what the statement says, but those are two very different things. So let's get into some of the chain reactions. So if you've got money in a 401k and an IRA, what's the problem? Hey, Greybeard, what's the problem? What are you trying to say? Well, hold on a sec. I'm going to get to that in a moment. But here's what I want to say. This whole show is going to be on why you should consider strategic Roth conversions. Strategic Roth IRA conversions. So before I get into the real meat of this, I want to just ask you a question. If I could show you how to convert your IRA or 401k with no out-of-pocket cost, no increases in your tax bracket, and no loss of your principal, so be able to take it from pre-tax to tax-free, would that be worth a 30-minute appointment with me? Now, if so, here's what you got to do, okay? This is for people that would like to talk with me about how to take pre-tax money and make it tax-free. We expect a lot of interest in this offer, so I've got limited time, small family office. My wife of 32 years, Jen, she handles my calendar, okay? You can start the process if you want to get on my calendar to talk about how I can help you potentially take pre-tax qualified money, turn it into tax-free with no out-of-pocket cost, no increase in your tax bracket, no loss of principal. Text ROTH, ROTH, to 84503 on your smartphone. So go to your texting app, key in that 84503 number, that 84503 number. Key that in like it's a cell number, like it's my cell. It's not my cell. It's just a texting number, but it'll work like a cell in terms of texting. So key it in on your messages. Then just type one word, Roth, ROTH. Text Roth to 84503. That lets us know that you out in Radio Land say, hey, listen, I understand your point. I hear you, Shawn. I hear you, Greybeard. Listen, I'd like to take some qualified, highly jeopardized, highly liable tax money on the 401k and IRA side, and I'd like to know how you can convert it to a Roth IRA with no out-of-pocket cost from me, no increase in my tax bracket, no loss of principal. Text Roth to 84503 if you'd like to have a conversation with me about that. All right, so let's get into chain reaction number one, the day you stop choosing. So here's one of the main problems for people that have, I would say, decent wealth. What do you find as decent wealth? Well, if you've got enough money through retirement, investment, savings, and other things where you don't need your IRA or 401k, this problem is going to be one you want to pay attention to. So required minimum distributions, those things hand the calendar to the IRS. Starting at age 73, you are forced to withdraw money out of your IRA and 401k accounts. Whether you need the money, whether you want the money, or whether the market even cooperates that year, you're forced to take money out against your will. That's not a figure of speech. That's the actual legal mechanism. So let's pick the story back up with Hank and Donna. Okay, he had $500,000 in his retirement, goes to retire. 11 years pass. Hank turns 73, and the mob boss partner we just met stops being patient. The IRS says, hey, listen, you're 73. We want some of that money. We want the taxes from that money. So in that span, a few things happened. Hank and Donna sold a rental property they'd held on to since their 30s. Good timing, great gains, exactly the kind of year where extra taxable income was the last thing that they needed. And that same year, a letter from the mob boss, the IRS, a letter arrived straight from the IRS. It wasn't an invitation, it was a requirement, telling Hank exactly how much he had to pull out of that IRA before December 31st or face a penalty. Guess how much the penalty is if you don't do this right? Guess how much they charge you as a penalty if you don't calculate the number correctly? 25%. They take 25% of whatever you didn't take out that you were supposed to. That's not a typo. If Hank misses his required minimum distribution, even by accident, even because he genuinely didn't need that money that year, the IRS does not send a polite reminder. They take 25% of whatever he should have withdrawn right off the top as a penalty on top of the regular tax he still owes anyway. Now, here's what really stings about Hank's situation. He didn't need that money. The rental property sale already covered what he and Donna wanted for that year: a kitchen remodel, a trip to see their daughter's family in Colorado. He had zero use for an extra distribution on top of all of that, but the IRS doesn't ask what you need. There's a formula. Your account balance divided by a number pulled from the IRS chart about how long you're going to live. It spits out exactly how much you're required to take. No emotion, no flexibility, just math. Whether the market was up or down, whether you had other income or not, whether you wanted to spend it or just keep it growing untouched, it doesn't matter. They forced you to take it out. That forced withdrawal landed right on top of the rental property gain, and suddenly Hank and Donna weren't in the tax bracket they'd planned around for 30 years going into retirement. They were a full bracket higher for 1 year simply because the calendar said 73 and the IRS doesn't negotiate timing. Now, I want you to sit with that for a second, because this is the part most people never connect until it's already happened to them. For your entire working life and most of your retirement, you got to choose. You chose how much to contribute. You chose when to retire. You chose within reason how much to pull out and when. And then one day, the year you turn 73, soon to be 75, depending on your birth year, that choice gets taken away, not gradually, all at once. The IRS picks the amount, the IRS picks the year, you just sign the withdrawal form, and you got to pay the tax. Otherwise, that 25% penalty is coming for you. That's the day you stop choosing. And it doesn't happen once. It happens every single year from that point forward for the rest of your life. And the number every single year only grows. The percentage that you're supposed to take out grows with each year you age. So they will make you systematically extract all of the money out of that account so that you can pay all the tax on it. And guess what? Roth IRAs do not have any required minimum distributions. There is no such thing with a Roth IRA. Whoop, I'm getting ahead of myself. Let me get back to Hank for a second. Getting too excited. I'm telling you the punchline to the joke, right? So Hank put it to me simply during one of our meetings. He said, I spent 30 years being told to save more, contribute more, max it out. Nobody ever told me there'd be a day where I'd have to take it out whether I wanted to or not. That's the trade nobody explains to you up front. And it's exactly why we're spending this hour talking about an alternative. See, what I love about Roth IRAs is there are no required minimum distributions. There is no forced withdrawal. Now, in a second, I'm going to tell you how that one RMD, that one required minimum distribution, the year you didn't really need it, the year you didn't really want it, that one RMD creates a cascade of other expenses, taxes, and charges that most people don't see or calculate or even know existed. I'll get into that in just a second. But here's the point that you need to understand. The only place you're going to have maximum control of your money is a Roth IRA. It's 100% tax-free. If you wanted lifetime income, I'd rather get it from a Roth IRA. If you want tax deferral, I'd rather get it inside a Roth IRA. If you want principal protection, I'd rather use an annuity with a Roth IRA. No matter which way you look at it, think of it this way. If you're somebody that hasn't saved what you think you should have saved, because the number one fear of retirees is outliving their money. Something like 78% of retirees worry about outliving their money. Well, there's absolutely one way to make sure you never outlive your money. Guess what? It's an annuity. It's the only mechanism, the only vehicle, the only thing in this investment world that will guarantee that no matter how long you live, they will continue to pay you money. And I would argue that tax-free versions of that are the best. Because I think looking out in the future, $39 trillion. You know, when I got into the financial services business, it was back in 2000. You know what our national debt was back then? $5.9 trillion. We are at 39 trillion. In the span of my career, 25 years in financial services back to 2000, in that span, the national debt has gone from 5.9 trillion to 39 trillion. I used to talk about it way back then, how burdensome it was. And now look where it's at. 330 grand. Taxes, in my opinion, have to be higher later. And the jeopardy of traditional IRAs is that you're going to get skewered at some point in taxes and a cascade of chain reactions, which I'm going to get into in a second. So let me do this. Okay. Roth IRA is the answer. So here's the question. If I could show you how to convert your IRA 401k money when you go to retire, or before retirement, or now if you're in retirement, if I could show you how to convert with no out-of-pocket cost from you, no increase in tax brackets, and no loss of principal, would that be worth a 30-minute appointment with me? If yes, take out your smartphone, go to your messages app, however you send a text message, key in the following number as though it's a cell number. It's only 5 digits, 84503. And then I just want you to text one word, Roth, R-O-T-H. Text Roth to 84503. That lets us know you out in Radio Land, you recognize the problem. You know the assignment. The assignment is to solve the problem. The problem is the taxes and the cascade of disadvantages that IRAs get to, which I'm going to get to immediately next. But if you'd like to learn how to convert pre-tax money to tax-free with no out-of-pocket cost, no increase in tax bracket, no loss of principal, that's what I'm offering to show you. Text Roth, R-O-T-H, to 84503 and be ready for a call back. Text Roth to 84503. Okay, I'm a small family office. We are expecting a lot of interest in this offer. I have limited time available. I'm a small family-owned office. My wife of 32 years, Jen, she handles my calendar. Be nice. She's my high school sweetheart. Okay, we've been together for 32 years. The people that I send to her, I want them making it easy for her. She's been a homemaker all of her life, raising our 4 boys. But you can book a call with me through her by texting Roth to 84503. One last time, text Roth to 84503. All right, let's get into chain reaction number 2. So the first chain reaction of qualified money, IRAs, 401ks, is that you are forced at the age of 73, whether you want to or not, whether you need to or not, take money out. That triggers a tax, and it only gets worse with every year you age. Here's chain reaction number 2. Okay, your own Social Security could become taxable. See, the RMD, the required minimum distribution, doesn't just create its own tax bill. It can quietly drag a portion of your Social Security benefit into taxable territory as well. So I used to call what's coming next a domino effect, but dominoes just fall. They don't reach out and grab more than what's already tipped over. What's actually happening here is more aggressive than that. It's a chain reaction. One root cause, that forced required minimum distribution we just talked about, and 3 compounding costs stacking right on top of it. Chain reaction number 1 was the RMD itself, forcing Hank to pull money out on an IRS schedule, not his. So here's chain reaction 2. Picture Hank and Donna again, the year after the first big RMD hit. So they had to take money out. They sold a house. It's the year after. Tax season rolls around, and their accountant calls with something that genuinely surprised both of them. A chunk of their Social Security benefits, money they'd paid into for 40 years, money they always assumed was simply theirs, untouched, was now showing up as taxable income on their return. So here's the headline. And I'm not going to walk you through the IRS formula on the radio because that's not what this hour is for. The short version is the more income you show in a year, and a forced RMD, the required minimum distribution, counts as income, the more of your own Social Security money, the benefit, your check, gets pulled into taxable territory. For a married couple, that can mean up to half your benefits become taxable. Push the number even higher, up to 85% of your Social Security benefits can become taxable. 85%. Read that again. Not 85% of some bonus payment. 85% of the actual Social Security check you and your spouse paid into your entire working lives becomes taxable. Now think about what we just talked about through with Hank's RMD. That forced withdrawal didn't sit off in its own little box separate from everything else. It landed directly in the other income side of his tax return. The bigger the RMD, the higher the provisional income number climbs, and the more of their Social Security check crosses over into taxable territory. One forced withdrawal, and suddenly a benefit they thought was protected gets pulled into the tax conversation too. That's chain reaction number 2. It's a cascade. And the disadvantage of IRAs and 401ks is not just limited to tax talk. It's now it's affecting now Social Security as well. Hank and Donna didn't do anything different. They didn't take a bigger withdrawal because they wanted to spend more. The formula simply forced a number out of that account, and that one number knocked over a second number sitting right next to it, their Social Security taxation. And most retirees never see the connection because the two pieces of mail don't arrive together. The RMD happened one year, and then you get notified the next year that, hey, guess, because your income went up, guess what? You're now going to have to pay more of your Social Security benefits as taxation. On top of that, by the time they connect the dots, the money's already gone. The problem has already happened. And I asked Donna how she felt when she found out. She said it felt like being taxed twice on the same dollar. Once when it came out of the IRA, and again, indirectly, through a benefit she'd already paid payroll taxes on for 4 decades. And honestly, that's a fair way to describe it. It's not double taxation in the technical sense the IRS would argue, but it sure feels that way at the kitchen table. That's for sure. Here's the piece I really want you to take from this. This isn't a Hank and Donna problem. This is a you problem. This is a math problem. The math doesn't care whose name is on the account. If you've got a traditional IRA of any meaningful size and you're collecting or about to collect Social Security, this formula is either already affecting you or it's waiting for the year your RMD gets large enough to trigger it. The only real question is whether you find out about it from me ahead of time on a Wednesday evening or from your accountant after the facts the way Hank and Donna did. And let me just reiterate here, the solution is a Roth IRA. A Roth doesn't trigger any of this. The Roth IRA is the best place to have long-term retirement money because it does not have a cascade of chain reactions that create disadvantages for you. Let's talk about chain reaction number 3. The Medicare bill. Nobody connects to last year's RMD. So now let's follow Hank and Donna one more year down the same road because the chain reaction isn't done yet. It's not finished. About a year or two after that big required minimum distribution we've been talking about and the surprise on their Social Security, okay, a letter showed up from the Social Security Administration, not the IRS this time, informing them that their Medicare Part B and Part D premiums were going up. It wasn't a plan change. It wasn't Medicare getting more expensive across the board. It was a tax-triggered premium hike tied directly to their income from a year or two earlier. This is called IRMAA, IRMAA, the income-related monthly adjustment amount. And it might be the least understood piece of this entire puzzle because of exactly that delay. Medicare looks back to set your premiums. So the RMD, the required minimum distribution, Hank took that year he sold an investment property, the year he didn't need that RMD, but he was forced to take it anyway because he turned a certain age. That RMD bumped his and Donna's income up for that year. Didn't show up as a consequence right away. It waited. And then almost exactly when they'd stopped thinking about it, 2 years later, it arrived as a higher monthly bill for both of them because IRMAA, IRMAA, applies per person, not per household. So I want to give you a sense of scale here because the number sounds small, yet you let it compound and it gets much bigger. Crossing into one of the IRMAA brackets can add a few $100s a month per spouse to what you're paying for Medicare. That's not a one-time fee. That's every single month for as long as your income stays in that bracket. And if your RMD keeps growing as the account grows, which they will, you can find yourself stuck there or pushed into the next tier up year after year. Here's the part Hank said genuinely frustrated him more than anything else we've talked about today. He said, I didn't even know this was a thing that could happen. I thought Medicare was just a number you paid and that the number was the same for everybody. It's not. And by the time most people realize their RMD from a couple years ago is the reason their Medicare bill jumped, they've usually already been paying the higher amount for months or years. This is why I call it a double, sometimes triple compounding problem. The RMD itself is a tax. The Social Security taxation we talked about is a second cost, riding on top of that same RMD. And now IRMA is a third cost, riding on top of that same number, except this one doesn't even show up until a year or two later, so you don't think to connect the dots, attached to a letter that has nothing to do with the IRS at all. 3 separate consequences, 1 root cause. And almost no one in the room tonight, no one is talking to you about this. This is one reason why I'm doing the show, to sit down and connect all 3 of them in one conversation. That's exactly what we're doing right now. If you take nothing else away from this segment, take this. The size of your required minimum distribution isn't just a tax question anymore. It's also a Social Security question. It's also a Medicare question. And if those 3 things are stacking on top of each other without you ever having mapped it out, you don't actually know what your real retirement income looks like. You know what your account balance says. You know what they're projecting, but you don't know how much of it you're going to get to keep because they tax or penalize you in these other ways. So all the more reason, I keep trying to reiterate this. It's all about tax-free. It's all about the Roth. So let me ask you a question. As you hear all of this, cascading chain reactions, benefit losses, taxation, more cost of Medicare. If I could show you how to take IRA money, qualified money, and turn it into tax-free. If I could show you a way to convert your IRA to a Roth with no out-of-pocket cost, no increase in your tax bracket, no loss of principal, would that be worth a 30-minute call with me? If yes, here's what I would suggest you do. Take out your smartphone, get in touch with us. We initially communicate with our audience via text messaging. You can text Roth, ROTH, to 84503. Text Roth, ROTH, to 84503. Now, I expect a lot of interest in this offer, and I have a limited time, small family office. So my wife of 32 years, Jen, we're high school sweethearts. We have 4 boys. She handles my calendar. You can book a call with her simply by starting the process, texting Roth to 84503. And again, we will show you, if I'm able to, I'm pretty good at this, but if I could show you how to convert your IRA to a Roth tax-free with no out-of-pocket cost, no increase in tax bracket, no loss of principal, I know what I would say. That would be worth a 30-minute call. So text Roth to 84503. All right, let's get into what we call the widow's penalty. This is chain reaction number 4. This next one is part of the Hank and Donna story that's harder to talk about. And I'm going to be honest with you. It's the point in this hour where I most want you to really listen, because this isn't theoretical for a huge number of people out there in Radioland. If Hank dies tomorrow, everything we've been talking about changes, often for the worst. Okay? It's a predictable financial outcome, and predictable outcomes are exactly the kind of thing we can plan around if somebody tells you about them in advance. So think of it this way. Here's what happens. The year Hank passes, he passes away. Donna still has to take essentially the same required minimum distribution from that IRA. The account doesn't shrink just because there's one less person in the household. But here's what does change. Donna's filing status. After the transition year, she would file each year after as single. And the tax brackets for a single filer are lower, smaller. They hit much harder, much faster than the brackets for a married couple filing jointly. So let me put a number on this so it's not abstract, right? So income that used to sit comfortably in a 22% bracket as a married couple. So let's say you're married. Hank and Donna are married. Maybe they're in a 22% tax bracket as a married couple. Hank dies. Now, Donna has to file as single. Well, at that income that put them in a 22% bracket as a married couple can push a single filer into a 32% bracket, sometimes higher on the exact same dollar amount. So the reason we call it a widow's penalty is that in this example, she's paying 10% more in tax on money because her husband died. Same RMD, same account, same income, but a meaningfully higher tax bill in the same year she's grieving, possibly adjusting to a single income from any pension or Social Security survivor benefit and trying to figure out the rest of her life alone. I think about this every time I run the numbers for a couple. The actuarial reality is that one spouse almost always outlives the other, often by years, sometimes by a decade or more. And the spouse left behind isn't just dealing with the hardest emotional season of their life. They're often at the exact same moment dealing with the worst tax season of their financial life through absolutely no fault or decision of their own. The IRS doesn't pause the RMD schedule out of sympathy. The brackets don't widen because there's only one income now instead of two. And Donna told me something I still think about. She said the tax bill that year felt like one more loss stacked on top of the loss she was already carrying. Not because the dollar amount itself was unbearable, but because nobody had ever warned her that it was coming. Hank had always handled the money stuff, as she put it. And the one year she most needed clarity and calm, she got a letter instead that made an already brutal year even harder. Completely predictable math and predictable problems are exactly the ones we can solve and plan for in advance. It happens. Couples don't plan for it, and the math punishes them anyway. If you are a married couple listening to me right now, one of you is statistically going to face exactly what Donna faced. The question worth asking right now isn't whether that day comes. It's whether the person left behind inherits a tax problem on top of everything else they're already carrying, or whether you did something about it while you still could. Let's talk about point number 6. It gets worse. Here's the inheritance time bomb. So let's finish Hank and Donna's story, because there's one more link to this chain reaction. And this one doesn't even land on Hank and Donna. It lands on their kids. Donna eventually passes away. The remaining IRA balance to their 2 adult children, both in their late 40s, both established in their careers. One's a regional manager for a logistics company, the other a nurse practitioner with their own household income. Good kids, responsible, exactly the kind of people you'd want inheriting something from you. Here's what almost nobody in this audience and out there in Radioland knows about how that inheritance actually works today. It changed a few years back under a law called the Secure Act, and it changed in a way that catches families off guard. It used to be that an inherited IRA could be stretched out over a beneficiary's entire lifetime. So in other words, if your children inherit your IRA, they could pull the money out of the IRA over a schedule that would allow them to withdraw it over their lifetime. So the longer that they can elongate the payments, the less the payments are, the less the tax. Small required withdrawals spread across decades, keeping the tax manageable. That was the way it used to work. That's gone now. Today, in most cases, a non-spouse beneficiary, your kids, has exactly 10 years to fully empty that IRA account. No stretching it out, no flexibility on timing. 10 years and the balance has to hit 0. So now I want you to picture Hank and Donna's son. He inherits his share of that IRA right in the middle of his highest earning years, late 40s, established career, solid salary on his own. Now he's got 10 years to drain a 6-figure inherited account on top of that salary, which means stacking large taxable withdrawals directly onto an income that's already pushing him into a higher bracket by itself. He didn't do anything wrong. Donna didn't do anything wrong. Hank didn't do anything wrong. He didn't make a bad decision. He simply inherited money at the worst possible moment in his own tax life to receive it, and the law gives him no real way around that 10-year clock. This is the piece that gets me every time I explain it to a client, because here's the uncomfortable truth nobody wants to say out loud. Hank and Donna spent 30, 40 years being careful, disciplined, doing exactly what they were told. Contribute, defer, let it grow. And the reward for all of that discipline, if nothing changes, is handing their kids a tax problem precisely when their kids can least afford the bracket hit. The silent partner we talked about at the start of this hour doesn't disappear when you pass away. He finds a new name to attach himself, your kids. And I want you to think about that for a second. Are they in their peak earning years right now? Do you have children in mid-40s, 50s, established careers, maybe even higher earners than you were at their age? Because if the answer is yes, and you're planning on leaving them a traditional IRA, you're not just leaving them money, you're leaving them a tax bill on your timeline that lands at the exact moment in their financial life when it'll cost them the most. Again, not a strike against Hank and Donna. They did everything right by the rules they were given 3 decades ago. The rules, though, have changed underneath them, and nobody sent them a memo. That's exactly why we're spending this hour talking about this problem. And it's exactly why I've said, and will reiterate right now, the only solution to this problem is a Roth IRA. Roth IRAs are tax-free. The biggest disadvantage to a Roth has always been paying the tax. Hey, Greybeard, I love the idea of Roth, but man, If I convert, I'm going to have a big tax bill. Maybe, maybe not. Here's the question. If I could show you how to avoid all of this, if I could show you how to not have these chain reactions, if I could show you how to spend more of your own money in retirement because it's 100% tax-free, if I could show you how you could convert your IRA to a Roth IRA that's tax-free with no out-of-pocket costs from you, no increase in your tax bracket, and no loss of your principal, would that be worth a 30-minute call with me? If yes, take out your smartphone, go to your texting app. We communicate with our audience initially via text messaging. You can text Roth, R-O-T-H, Roth to 84503. Text Roth to 84503. That lets us know that there's somebody out in Radio Land that says, hey, I don't want to pay taxes. I don't want to deal with having to pay $335,000 of national debt on my back. I want to have a tax-free solution. If they change the taxes in the future, tax-free is better. If taxes go up in the future, tax-free is better. If taxes go down in the future, tax-free is still better. When is tax-free not the ultimate position to be in? If I could show you how to convert with no out-of-pocket costs, no increase in tax bracket, no loss of principal, would you want to talk to me? Text Roth, R-O-T-H, to 84503. Now, keep in mind, we expect a lot of interest in this offer. We have limited time. I'm a small family-owned office. My wife of 32 years, Jen, she handles my calendar. We're high school sweethearts. When you text Roth to 84503, she's going to reach out and touch bases with you and see if you can, if she can book you onto my calendar. And so we want, if you're seriously interested in a solution to this problem, that's why you'd text Roth to 84503. All right, now it's time to start talking about the Roth blueprint, the solution. Paying it once, paying the tax once on your term and eliminating all of these other chain reactions, these disadvantages. See, a Roth conversion would let Hank and Donna settle their entire tax question once on their own schedule, often without writing a check out of pocket, and stop the chain reaction we just walked through this whole hour. So I want to rewind the tape now because I've spent this whole time, this almost an hour now, walking you through everything that happened to Hank and Donna. The silent partner that they have. You know, how much money do you have in your 401k right now? Yeah, I asked this question at the beginning of the show. I'm going to ask it again. How much money do you have in your IRA 401k assets, your retirement assets right now? Everybody out there in Radio Land, you think of a number. Well, how much is the number? You know the number. You've been looking at it. You've seen it at least once a month or quarterly. What is that number? How much money do you have in retirement accounts? Somebody out in Radio Land's thinking about of $200,000. That's what you're saying. But see, here's the point. It's not all yours. Some of that is Uncle Sam's. It's never been taxed. He wants his due. He's the silent partner. He's the mob boss partner, more like. Not really a silent partner. They're quite vocal when they want to be. You got the forced RMD, required minimum distribution out of IRA accounts. IRAs force you to take a minimum amount out starting at the age of 73. Roth IRAs do not. There is no silent tax partner in a Roth IRA. There is no mob boss in a Roth IRA. There is no forced required minimum distribution. Then we talked about the Social Security hit. Taking money out of a traditional IRA could trigger more Social Security tax on your Social Security income because you're making too much money. You're too successful. You have too much money. See, what Social Security has become is the more successful you are, the less of it you get to keep. The least successful people get to keep the most. If you weren't successful, you get to keep all of your Social Security. If you were super successful, you get to, guess what? You get to pay tax on 85% of it. Then we talked about the Medicare surcharge. And then we didn't stop there. We talked about the widow's penalty. What happens when one spouse dies, leaves the other spouse behind. That other spouse gets the IRA money. Now they've got a combined RMD that they've got to take. And now they're single. So they're going to be in a higher tax bracket because single people have smaller, lower tax brackets that change more quickly than do married folks filing jointly. And then it wasn't even done there. We talked about the inheritance time bomb. The kids getting left money in IRAs that then burden them. Now, some would say, well, hey, they're getting the money, man. It's free money to them. Well, here's the point. If anybody's going to get the money, wouldn't you rather the kids get it versus Uncle Sam getting half of it? Like, if you're going to leave your wealth to somebody, shouldn't the kids benefit fully from it? Wouldn't you rather be able to pass it on to them and grandkids than to have half of it go to the IRS? So let me talk about another version of their story. One where at 61 years old, before any of that drama, before any of those challenges, before any of those chain reactions began, Hank and Donna sat down with someone like me who showed them a different path. Here's what that path looks like in plain terms. Instead of leaving the full $500,000 sitting in that traditional IRA, waiting for the IRS to set the schedule, we map out a Roth conversion plan. A systematic plan of converting money from an IRA to a Roth IRA strategically, systematically, year over year, moving a portion of that account from taxable to tax-free, spread across several years, specifically sized to stay under a tax bracket Hank and Donna chose themselves, instead of the one IRS forces on them later. That's the entire idea behind a Roth conversion. You pay the tax once, now, while you're the one deciding the amount and the year, not your 73-year-old self 20 years into the future, not your widow, not your kids and their peak earning potential. Now, here's where it gets interesting. Because the next question every single person asks me is some version of, hey, Greybeard, listen, I'm following you. I really am. But here's the question I have. Where does the money come from to pay that tax? It's the right question. And it's exactly why I use a system called the Roth Blueprint. It's exactly how I work with most people. Most advisors, most financial advisors out there. I was a financial advisor for 22 years. I'm not that. I'm an insurance guy now. Most advisors simply don't have a tool built for this specific problem. I've got the perfect tool for this problem, built exactly around this scenario. In many of the strategies I put together, the funds to cover that conversion tax come from inside the plan itself, not from your savings account, not from selling something else, not from disrupting any other part of your financial life. And in a lot of cases, the carrier we use credits a premium bonus when the account is funded. That bonus, often substantial enough to cover a meaningful chunk, sometimes nearly all of the tax bill that the conversion creates. And you get a blueprint of it. You get it all in bright pictures and very detailed numbers. Now, somebody out in Radio Land is, hey, I have to have my tax guy or CPA take a look at this. I mean, this sounds too good to be true. It's not too good to be true. It's math. We will show you the math. And the math is so detailed that any tax guy you bring or send or want to take a look at it is going to verify that it's legitimate. First, what I'm doing absolutely costs you nothing. Your full do-nothing tax projection, line by line. Second, exactly how a conversion plan reduces that liability. We will show you how much more money you would likely have by doing a conversion than you would have if you leave everything the way it is right now. Third, what your income could look like if we get you to 100% tax-free. The 78% of retirees are worried about outliving their money. It's the number one concern of retirees. Well, here's what I'm going to say. If you had guaranteed lifetime income, you would never worry about outliving your money. And if you had tax-free income, that money would go further. If you can imagine at some point in the future, tax rates go to 50%. The average person in this country is paying 50% because our burdensome debt is just so caustic. Imagine 50%. Imagine you having 40 or 50 grand of tax-free income. That'd be like having 80 or 100 of taxable income. It's how you make up the ground. And the principal, the money Hank and Donna actually started with, never touches the stock market during any of this. It's protected. That's the whole point. I like fixed indexed annuities because I can look you in the eyes and say, you will never, ever, ever lose money with me doing this. Because here's one of the biggest disadvantages of your financial advisor that you work with. If they suggest you do a Roth conversion, here's what's going to happen. They're going to take the conversion out of the account that you converted from. They're going to withdraw it out of the IRA. Now, here's the challenge. If you did a conversion now, let's say you did a conversion today, like in June of 2026, but whatever stock you converted, let's say it was stock you converted to a Roth IRA. Let's say the stock, Elon says something, it's Tesla stock or something else, it's SpaceX, and he says something that upsets people, and that the stock falls 20%. Now you're paying tax on gains you didn't even realize. In other words, you converted in June, and by October, the stock fell. Now you're paying tax on gains you don't even have anymore. There is no way to do that with insurance products. There's no ghost tax gains. And again, the money never touches the market. It's protected. If the index has a rough year while the conversion plays out, their account doesn't lose a dollar. Zero is the floor. Zero is your hero. And here's something that most people don't find out about until it's already happened to them. And it's exactly why the vehicle you convert into matters as much as the decision to convert at all. Say you convert a chunk of the IRA in February. Okay, this is the ghost money, right? You convert a chunk in February when the account's sitting at its highest point for the year. Then the market has a rough October, and by December, the account's worth less than what you paid the tax on. You don't get that tax back. People in this business call it the ghost tax. If you're not using an insurance product, you could be susceptible to the ghost tax. A tax bill on money that by the time you look at your end statement isn't even there anymore. That's not a flaw in Roth conversions. That's a flaw in converting into something that can lose value. I don't do that. We don't do that at all. This is really what I mean when I say insured money. Think about velocity of money for a second. Getting $1 to look and act and work like $5 instead of just sitting there as $1 doing nothing. That's the opposite of what happens when a dollar gets stuck in the wrong account for 30 years and your silent partner gets it. Insured money strategies, what I'm doing with insured money strategies flips that around. You put $1 into a properly structured, principal protected plan, and that $1 goes to work eliminating every problem we've spent this hour walking through today. The silent partner, the forced withdrawals through RMDs, the Social Security hit, the Medicare surcharge, all of it. That's the whole idea behind the name of the show. So walk that forward with me. Hank's RMD at 73 never forces an unwanted bracket jump because there's no RMD on Roth dollars. None. Ever. Donna's Social Security never gets pulled into taxable territory by a forced withdrawal that no longer exists. The Medicare surcharge never shows up because that income that would have triggered it never landed on their return. And if Hank passes first, Donna isn't ambushed by a tax bracket on top of her grief. Roth distributions don't even show up as taxable income on the return. And when it's finally time to pass what's left to their kids, those kids inherit it completely tax-free. No 10-year scramble, no stacking it on top of their own salary at the worst possible moment. So as we close out the show, here's the whole thing tied together in one simple sentence or question, I guess. If I could show you how to convert your IRA that's 100% taxable to a 100% tax-free Roth IRA without any direct out-of-pocket costs, without your balance ever dropping below where it stands today, and without pushing you into a higher tax bracket, is there any reason you wouldn't want to move that money from taxable to tax-free? It's not a sales line. That's everything we just walked through, all three pieces working together. So here's a fun side effect nobody warned you about. Once you understand this stuff, you start sounding like the smartest person at every dinner party you go to. Same couple, same $500,000, two completely different stories. And the only thing that changed was when they decided to find out about this and from whom, and when they decided to pay the tax. If you'd like me to run your Roth blueprint, if you'd like me to show you in real numbers what it looks like, here's all you got to do. Grab your smartphone right now. Go to your messages app. Key in the following number, 84503, 84503, and then just text Roth, R-O-T-H. Text Roth to 84503. Now listen, we're expecting a lot of interest in this offer, and I've got limited time. It's a small family office. My wife of 32 years, my high school sweetheart, she handles my calendar. You can get on my calendar by texting Roth to 84503, and she will reach out to you directly and book an appointment with you to talk with me. And the premise is we are going to see if we can convert that traditional IRA to a Roth so it can become tax-free for you. All you got to do is text Roth to 84503. And rest assured, my friends, I'm going to be back here same time, same place next week to talk more. Greybeard out. This is The Greybeard Show.
The Greybeard Show. Learn.
Build.
Grow.